The best way to master anything is to learn from those who are already mastering it. Here are the 9 most important investment advices from legendary investors. First gem comes from Warren Buffett. Somebody is sitting in the shade today because they have planted a tree a long time ago. This touches the most fundamental principle of investing, that is delayed gratification. When you invest, you give up something today to have something more in the future. Time is the vector that brings you there and allows today's investment to grow and compound. Besides obviously picking a good business, being patient and allowing time to do its job is crucial. Time is such a central part of investing that the majority of investing principles are based around it. The second investment gem is only buy something that you would be perfectly happy to hold if the stock market shut down for 10 years. The ticker price of the investments is a short-term distraction. What matters is buying value and then allow enough time for that value to flourish. Warren Buffett is telling us that keep laser focus on finding wonderful businesses and keep at the side all that short-term noise of the charts going up and down. In the short term, the stock market is a voting machine. In the long term, is a weighing machine. It has been shown over and over again that in the long term, returns follow the underlying fundamentals of the businesses. So focus on what matters, value. It will be eventually recognized over time. Price is what you pay, value is what you get. Price and value are not always one and the same. A stock going up doesn't necessarily mean that the business is worth more. Finding discrepancies between price and value is precisely what gives us investors an opportunity for great returns. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than have been lost in the corrections themselves. Here, Peter Lynch is telling us that timing the market beats timing the market. It is essentially impossible to anticipate corrections or market crashes, or bad news, etc. Time will lift wonderful businesses to higher and higher valuations, so it is extremely counterproductive to stay in the sidelines because of some macroeconomic event that might happen. The best way to invest is to be in the market and to be in great businesses. Go for a business that any idiot could run, because sooner or later, any idiot is probably going to run it. Here, Peter Lynch tells us that for an investment to work in the long term, it must be based on a strong and relatively simple business model. It is extremely dangerous to base investment decisions on a charismatic leader. The business model itself must be robust and have a big moat, regardless of whoever is in charge. An investment in knowledge pays the best interests. Time spent for learning and education will pay interest for a lifetime, and there is arguably not a better use of time than that. The biggest risk of all is not taking one. Risk is an intrinsic part of investing and life as a whole. Risk can bring about the highest opportunities and reward, as well as risk can wipe you out of the game. Managing risk is the finest art of investing. Embrace it, but never allow it to end the game. The most contrarian thing of all is not to oppose the crowd, but to think for yourself. This is Peter Thiel's tribute to independent thinking. If everyone is thinking the same thing, no one is thinking. Wisdom is to take into account all positions and then make a judgment of your own.